Thank you, and good afternoon, everyone, and happy official giving season. Hard to believe we're in December, and as everyone knows, the majority of charitable giving will be taking place within the next couple of weeks. So as Pam says, it's not too late to be talking to your clients and contacts about how to do their charitable giving. So I'm just going to go briefly through some of the statistics around charitable giving, and then turn it over to Ellen, who will drill down a little bit on why it's a good reason to be talking to your clients about charitable giving. And the numbers really, I think everyone has probably seen a lot of these statistics that were created, put together by Giving USA. These are the most recent numbers from this fall. And it shows that $373 billion were given to charity in 2015. And this is an increase for the sixth year in a row. But the thing to note that while it is an increase, it's not as much as in prior years, the change. So we can read into that what you want, but it's still lots of money out there. And one of the things that has changed, finally they made permanent the IRA charitable rollover. So people can earmark their required mandatory distribution directly to a charity, which is great, and really for a lot of people that's going to be a good benefit to them. Something to keep in mind though, that it does not apply to donor advised funds, so you cannot designate your IRA contribution to your donor advised fund, but we're hoping perhaps that will change at some point. And the other big buzz earlier in the year was the gift by the Chan Zuckerbergs that decided to use a charitable LLC for their charitable giving and their philanthropy. And I think, as we used to say, watch this space, because it's really pretty interesting to see that people are looking to make social impact in a different way. I guess next slide, please. And this chart really shows the growth of philanthropy. I started in this business in the late 90s, and you could see over that time it's grown by over $125 billion. So you could point to a lot of different things that might be contributing to that. Clearly donor advised funds is one of the things that I think has helped democratize philanthropy and made it a lot more accessible, being able to contribute appreciated securities and avoid capital gains. So I think people are just being a little more smart about their giving, and I think from technology it's just becoming a lot more accessible. So we can only imagine that this upward trend will continue, because even in the down years it was down, but it recovered fairly quickly. Next slide. And then again, the where's the money going? Biggest chunk consistently has always been to religion. That's, I guess, the great tradition our country was founded on. But then if you look over to public society benefit and gifts to foundations, if you add those together, so those are gifts to foundations, whether they're institutional foundations or family foundations, and then public society benefit includes the donor advised funds and United Way. That accounts for the next biggest chunk. If you put those together, that's 18%. So giving to those intermediary organizations, I think that's another interesting trend to be aware of. Next slide. And then the who is giving. I think a lot of people think about foundations as giving, but it's individuals who are given the lion's share. And then even if you look at foundations, and again, if you split that and include some family foundations that are still run by individuals, that number is even higher. So it just gives you the sense of who, these are real bodies of people that we could be talking to and helping them be more strategic with their giving, both on trying to obtain impact with their charitable giving, but also make sure they're giving those gifts in the most efficient way. Next slide, please. And then just drilling down a little bit more, that 71% of Americans say they contribute to charity. And in last year it grew, so it grew 5.7%. But because there are so many, the largest chunk of that pie is made up of individuals, an increase of 5% can really boost the overall giving, 58% last year. So most people that you're talking to, and according to the surveys that we've seen by U.S. Trust and others, says that 98.4% of high net worth households give to charity. And I think that even the higher net worth you go up, it's even higher than that, as well as on the lower end too. So this really, when you got a number like 98.4%, that's showing that this applies to most people that you're talking to. And 63% of those cite that giving back to the community was their chief motivator. Now, I would say regardless of their motivation, I believe donors want to be able to give in the most tax-efficient way. And to that point, no one knows what's going to happen to tax policy in 2017, or maybe nothing. It won't take effect until 2018. But from everything that we've been hearing from the incoming administration is that corporate taxes, they want corporate taxes to be decreased, the estate taxes to be repealed, a decrease in the personal tax bracket, decrease in capital gains, and I think important to people on this call is also a limitation of deductions, including charitable. Again, I have people ask me, well, what's going to happen? Well, if I knew that, I wouldn't be sitting here talking about philanthropy. So everything is up for discussion. So what we're doing here at Wells Fargo is scenario planning. So basically what that means is just it's a great opportunity in these uncertain times to be able to talk to your clients and just think through. One thing we know now is that taxes are very high. So indeed, if you believe that taxes are going to go down in the coming years, now is the perfect time to pre-fund some of your charitable giving. So whether it's through a donor-advised fund or other charitable trust foundations, take advantage of those or just prepay some other charitable commitments. So you're taking advantage of the tax rates while they're at their highest now and get the highest deduction. And then you'll have some additional funding set aside for your philanthropic giving in the future. And then again, even though we're talking about planning, next slide, sorry, most of the giving from individuals goes directly to the charities through direct gifts, so there's no vehicle involved. And something else I'd like to talk to people about is that cash is your most expensive asset to contribute to philanthropy because you're not taking advantage of any of those capital gains deductions that capital gains that you would be avoiding. So again, a good time to be talking about those who don't have any vehicles in place. But there are plenty of private foundations out there, a lot of smaller ones. There's lots of talk about changing payout requirements, these things that you may be hearing going forward. But clearly the biggest elephant in the room are donor-advised funds. They are the fastest growing donor charitable giving vehicle and really a very good solution for a lot of people. And in fact, when the new Chronicle of Philanthropy's top 400 list of the top fundraiser came out, it is in fact a commercial donor-advised fund that is #1 on the list. So you may be hearing more and more about donor-advised funds from your clients asking about them or your donors. So this is something that we think is just part of the landscape, and it's just a very exciting time to see that philanthropy is cutting across all kinds of conversations, and we'll be looking to you as advisors for additional input. As I talk to people, they always want to hear, what are other people doing? What are other foundations doing? What should I be doing? So being able to ask the questions of your clients is really critical. And Ellen, I think this is a good handoff to you to
Absolutely
go deeper as to why it's a good idea.
Okay, thanks so much, Janice. Thanks for that terrific overview of what's going on in the charitable sector. And I thought now we'd focus a little bit more on what clients are saying, what kind of feedback do clients have about the type of guidance and assistance they're looking for? And earlier, Janice, you mentioned the U.S. Trust Survey of High Net Worth Clients, and there was some very interesting data there that showed almost all high net worth individuals, as you noted, give to charities, some quite extensively. But what people may not be aware of is that in this survey, 34% of people surveyed felt that the topic of philanthropy should be raised during their first or second meeting. And 90% of the people in the survey agreed that this is a conversation that should be part of the planning conversation early on in the planning, and they feel that advisors hesitate to bring it up or do not bring it up at all. And this was something that clients felt was a misstep on the advisor's part. So why discuss charitable giving with your clients? First of all, it's good for society, it's good for clients, and it's good for your business. It helps you bring another level of expertise and also a more holistic approach to the planning. It can certainly help clients who are looking for a way to give back, people who are looking for a way to add some meaning to their wealth beyond just numbers and projections and looking at where they'll be at age 60, age 70, age 80 in terms of assets. They want to think about how to deploy those assets. It certainly expands your area of expertise as an advisor, gives you a certain value added, and it can marry your profession with the desire to do something good for your community and for society. If you are helping to empower your clients to have charitable impact, this is a way of really leveraging that impact and leveraging more philanthropic dollars to get out there where they're needed. Now I want to see if my slides work. Okay, that's excellent. So I know some folks are saying, well, my clients aren't all that interested in charity, or it seems awkward to bring it up. And I would recommend that introducing the topic at the right time is very helpful, and it certainly will increase clients' receptivity to the conversation. So year-end planning, we're in the moment. As Janice said, we're in the official season. We kicked off with Giving Tuesday. Both tax planning and year-end giving are already on clients' minds. So this is when they're ripe to have the conversation. Other times are really when you're speaking with a client who's had a promotion or a bonus. They're going to be in the frame of mind to consider sharing that type of good fortune with others. Another very common situation is when your client has highly appreciated securities. There's, as Janice was saying, you can really maximize the giving and have your client increase their impact by choosing the correct asset to give. And it's a win-win to be able to avoid the capital gains, have your tax deduction, and maximize the dollars available to give to one's favorite charities. This is an especially good year to do it because we really do not know what's on the horizon in terms of legislation. What we do know is there are quite a number of proposals floating out there, both in the House and the Senate, that include some fairly significant proposed restrictions and limitations on the charitable deduction, as well as a capping of the charitable deduction. And depending what happens with itemization, this is all going to have huge impact. So there could not be a better moment to have a serious conversation with your clients about charitable giving and making them aware that this window that we've had for a long time with, depending on your vehicle, taking 50% of adjusted gross income, that may not still exist in 2 years from now. So this is truly the moment. So let's see. Other times that are important to have the conversation, certainly if there's an inheritance, some kind of unexpected windfall, if a client is selling real property, it could be artwork, homes, a business. I'm going to leave this to Maura because there's a lot of considerations around gifting illiquids or non-marketables, but that's another incredible opportunity, depending on your client base, for really maximizing both the tax savings as well as the philanthropic dollars. Sometimes your client may bring up the topic themselves, and what I would strongly recommend to folks, and we have a large advisor network here at Jewish Communal Fund, and I speak with advisors all the time, and I suggest to them, don't jump into the conversation about the vehicle or the structure too quickly. This is a terrific opportunity to dig deeper and try to understand what is important to the client and what are they trying to accomplish more broadly. Not only will this help with your planning, this is really a way to strengthen the advisor-client relationship, and you don't get too many of these opportunities. Philanthropy is a great way to build the relationship. We like to work with our clients here at JCF, and many of the advisors we work with try to incorporate some of the client's values and priorities into the conversation. So this means asking the client, what does your success look like and what does it mean to you? What are you trying to accomplish with this money? How do you want to be perceived by family members, by your peers, by your community? What is this impact that you're trying to make? Where do you see charitable giving in your planning? And if you're more on the estate planning side than doing the annual tax side, what type of legacy do you want to leave? And these conversations will bring up a lot of concerns and considerations that the client has that can give you very, very valuable information for the planning. So it's not always easy with every client to jump into this conversation. Some clients want to open up and relish the opportunity and have given this some thought and reflected upon it. Other clients may not be at that point yet. They themselves may be struggling around some of these ideas and some of these priorities and really not have thought it all out. There's some great tools that are out there. We like to use a lot of the tools from a group called 2164, but there's so many great legacy tools out there. I recommend a few that I just put up here for your consideration. One is called Money Messages, and frankly, it's one of my favorite because it's an exercise that as an advisor and as a philanthropy advisor, I've done this exercise myself. It helps you uncover your own biases and issues and preconceptions about money and wealth. And let's face it, whenever we're talking to a client, we're still bringing some of our own history and some of our own perceptions and upbringing to that conversation. And I've done this exercise many times with advisors, and it's so interesting to drill down and explore some of the messages you've heard growing up or conversations you've had around money and wealth, and understanding your own perspective before you have these sensitive conversations with clients. Motivational values, there's loads of exercises and tools out there, but it's a great way to have the client take a step back to really look at what are the most central values that they're trying to use as the foundation for their planning. Picture Your Legacy is another great tool for people who are maybe not as comfortable with articulating things. It uses imagery, which also, when you're dealing with multi-generational families, I find this is a wonderful tool as well. So once you've been able to break the ice, you can have some open-ended questions to start the conversation. You may just point out to your clients that in order to create a comprehensive plan, you want to make sure you've considered all the things they're trying to accomplish and see if the client can tell you more about what that would be. You can speak about experience you've had yourself or with other clients, reflecting that many of your clients do support charities as a way of sharing their good fortune with those less fortunate, and that you're happy to discuss ways that you can help them engage strategically with philanthropy. Or simply pointing out that the client is in a strong place financially or has some significant increase in assets, and this is the opportune time to begin that conversation and perhaps looking at philanthropy in a more structured and strategic way. And in order to do that, you have to understand what's important to them and what they would like to accomplish. But this is a great time to think about structure and what people want to accomplish, because we really don't know the full impact of what Congress may decide to do, and whatever people can sort of put aside now, take full advantage of whatever tax deductions they can now, and then be able to have time to give that out. That is really going to be a huge win for your clients. So once you've had these values discussions, you have a broader sense of what the client's trying to do, who in the family is involved, how they would like to approach it. These are some more practical drill-down questions that you want to look at. What kind of income do they feel they need? What kind of tax savings are they looking for? What are they thinking about in terms of their heirs? Time horizon. This is a really big one. Are they trying to have a significant impact in their lifetime? Is it something that's more about their legacy? Is it something they want to do over an extended period of time? Or are they looking to have a big impact in a short period of time? So time horizon is really going to weigh heavily on how you put together a plan for the client. Control, and that's how much control do they want to have of investments, of grant making, of the mission, and how much control are they willing to give to others, whether it's a sponsoring organization or whether it's the heirs. Some people are, as many advisors know, are not that comfortable with leaving much control to heirs, so you have to know your client and how they feel about these issues. A really big one, and this has become huge in the last few years with technology, is privacy. How important is it to the client to have privacy? These days, with Foundation 990s easily accessible online, substantial amounts of information being disclosed and really accessible to fundraisers, to vendors, to anyone who might want to solicit you, to just people you don't want to have insight into your giving or your financial information. Privacy is a big issue, and there are not many options to ensure privacy for people except with the donor advised fund, because that is one of the very few vehicles where you can file or you report in the aggregate, so you're not offering the drill down on any individual account. But you have to know how sensitive are your clients to the privacy issue. Flexibility is another big one. What kind of flexibility do people have? Are they comfortable with having an annual minimum required distribution each year? Are they trying to avoid those kind of minimums? Do they need flexibility because they're looking at a long time horizon? Do they need flexibility to be able to engage multiple branches of a family or generations in the philanthropic process? And then charitable impact again. How great an impact over what period of time, and who do they see sitting at the table with them to create this impact. And I think discussing all of these points is essential to the successful planning and to determining the correct structure. And to speak a little bit more about that structure, I'm going to turn it over to Maura Whelan from Simpson Thacher.
Thanks, Ellen, and thanks, Janice. So now that we've sort of set the stage and had the priming conversations, once an individual has determined that he or she will make a charitable contribution, the next key step is going to be to determine how to structure that contribution. And I like to think about the considerations in this area as being in two main buckets. The first is, what are the deductibility considerations, and what is the tax planning consideration in the interest in making a charitable contribution? And then everything else. So impact, desired impact, the organizations that you're wishing to support, administrative ease, all of the other non-tax deduction considerations will also be important for any proposed donor. And I think it's important to note at the outset that in those two general buckets, one may take the lead at any particular time in connection with any particular contribution, and it may depend on why it is a donor is seeking to make a charitable contribution at a particular time. One of the issues that was mentioned earlier is if there is, if a donor has appreciated illiquid securities, for example, and there's an interest in sort of taking advantage of making a contribution to avoid capital gains, that may mean that the tax deductibility considerations take the forefront in that gift. But there may be other gifts where the actual motivation, a desire to support a particular organization, and those sorts of other factors take the forefront. So next slide, please. So there are four main structures that we'll talk about today. And another point I want to make at the outset is that these aren't exclusive to each other, and most donors who have major philanthropic programs will take advantage of each of the options at any particular time. And it's important to keep in mind that these can be used together. So the first structure is the private foundation. In the case of giving through a private foundation, a donor would establish a private foundation either as a corporation or a trust. The donor would apply to the IRS for recognition of exemption as a private foundation. And then the private foundation would be funded, and gifts would be made through the private foundation to other charitable organizations. It's a little outside the scope of our discussion today, but it's worth noting that in this new age where impact investing is of particular interest for philanthropically minded individuals, program-related investments are another way that private foundations can support charitable causes. The second structure is the donor-advised fund. In this case, a donor would establish a fund at a sponsoring organization which has been recognized as a public charity, and then from the donor's account that established at the public charity, the donor would make recommendations for distributions from the account to support charitable causes. The third option, which as Janice mentioned, is the bulk of individual giving, is to make a direct gift to a charitable organization. So a donor may make regular gifts to his or her alma mater or to cultural institutions in his or her community. And then the fourth category is supporting a foreign charity through what we call an American Friends Of organization. And the important background here is that a donor is not eligible for a charitable contribution income tax deduction for a charitable contribution to a foreign charity. Those charitable contributions must be made to a U.S. charity. So often foreign charities will have affiliated U.S. organizations that are American Friends of organizations that provide support to the foreign charity. These organizations need to be structured in a particular manner, and gifts from a donor to the American Friends of organization also need to be structured in a particular manner, and they can't be earmarked for the foreign charity. The U.S. entity, the American Friends of organization, needs to retain control and discretion over the gift. Next slide, please. So for the purpose of this discussion, we're really going to focus on the private foundation and the donor advised fund because those are in some ways kind of key alternatives to each other, but as I mentioned earlier, they can be used in concert as well. So what is a donor advised fund? A donor advised fund is a fund or account that's separately identified by reference to contributions of a particular donor or donors, that's owned and controlled by a sponsoring organization, and with respect to which a donor or individuals that are designated by the donor, and we call these people donor advisors, has or reasonably expects to have advisory privileges with respect to distributions from the fund. So that's the definition that's provided in the code. So for example, JCF has been recognized as a public charity and acts as a sponsoring organization of donor advised funds. And a donor can establish a donor advised fund at JCF by making a charitable contribution, and then we'll have advisory privileges with respect to distribution of funds from the account. There are some exceptions to the definition of a donor advised fund in the code. One important one is that a fund that makes distributions only to a single charity or governmental entity is not included as a donor advised fund. And just as a general matter, the donor advised fund form and that structural option is often considered to be the public charity alternative to giving through a private foundation. And we'll look at exactly why in a little bit more detail. Next slide, please. So then what's a private foundation? Under the code, a private foundation is a charitable organization that doesn't meet the definition of a public charity. So a private foundation is really the default classification for an organization that is a 501c3 charitable organization under the Internal Revenue Code. And there are three main features that a private foundation typically has. The first is that a private foundation generally has a single major source of funding. It's supported either by an individual or a family or by a corporation. The second feature is that a private foundation is generally a grant-making organization, and it fulfills its charitable purposes by making grants to other organizations rather than conducting direct charitable programs itself. And then the third feature is that private foundations generally pay for their grants and their ongoing expenses either from an endowment fund and the proceeds from the investments of the endowment, or some private foundations are actually annually funded by their main source of funding. So it's either from proceeds of the endowment investments or from annual contributions from their donor, rather than conducting a fundraising program, which is how public charities are typically run. So next slide, please. So going back to the two key categories of considerations and how to structure a gift, what are the deductibility considerations? So as a very general matter, public charities, and this includes donor advised funds, have advantages over private foundations with respect to deductibility. There are three income tax deduction differences for these purposes that we'll talk about. Those are the treatment of cash gifts, the treatment of gifts of appreciated property, and then the valuation of gifts of appreciated property. And next slide, please. So taking those differences in turn, for a cash gift, an individual donor is generally limited on an annual basis to a charitable deduction of no more than 50% of his or her adjusted gross income for gifts to public charities, and that includes donor-advised funds again. Gifts to private foundations are more restricted, and in that case, the limit is 30% of adjusted gross income. It's worth noting that there are some special types of private foundations that enjoy some of the public charity deductibility preferences. Those are private operating foundations, for example, but for these purposes, we're really talking about a private non-operating grant-making foundation, and in those cases, there is a less advantageous deduction limit. So for the second category, the deduction on gifts of appreciated property are limited to 30% of adjusted gross income for gifts to public charities and to the special types of private foundations, but to only 20% for gifts to private non-operating foundations. And in these cases, if the limitations are exceeded, and this harkens back to something that both Janice and Ellen mentioned earlier in terms of planning in this time of uncertainty, if the limitations are exceeded, there is a 5-year carry forward. So in addition to the percentage limits for appreciated property, gifts of appreciated property to private foundations are generally deductible only at basis and not at fair market value. There is an exception for qualified appreciated stock, but that is capital gains and publicly traded stock for the donor. So illiquid stock and other tangible personal property is limited to the donor's basis, which where the property has appreciated in value may really be quite unappealing for the donor from a deduction standpoint. Next slide, please. So with those deductibility considerations in mind, the donor advised fund is an attractive alternative, particularly for a donor that has appreciated property other than publicly traded stock. One point we just want to note here is that for gifts of tangible personal property, and artwork is an easy example here, the tangible personal property needs to be put to a related use by the public charity in order for the donor to be eligible for a fair market value deduction. So if the donor has a highly valuable and appreciated artwork, making a gift of that artwork to, for example, a homeless shelter is unlikely to allow the donor to claim a fair market value deduction, whereas gifting that piece of art to a museum or to a university or some other institution that includes the study or display of art as one of its charitable purposes. So that's just one thing to keep in mind for tangible personal property. Next slide, please. So apart from the deductibility considerations, there are other considerations that a donor should be mindful of in deciding how to structure a charitable contribution, and particularly in deciding between a private foundation and a donor-advised fund. Control is really the key advantage that a donor has in giving through a private foundation versus a donor-advised fund. And where a donor is willing to relinquish some of that control, there are other advantages that are gained. The deductibility that we already discussed is one of them. And there are other considerations, including administrative responsibilities and costs. And in that way, the donor-advised fund is an attractive option for a donor that is willing to not fully control the investment and grant making of its funds. Next slide, please. So from the standpoint of administration, as I mentioned, if a donor is going to elect to conduct its giving through a private foundation, the private foundation needs to be formed, it needs to apply for exemption, but there are also several ongoing administrative responsibilities that a private foundation has. Those include federal and state annual filings, there are tax-related obligations, and then there's also just this basics of needing individuals to run run the foundation, to run its grant making, to keep its books and records. In the case of a donor advised fund, those types of activities are handled by the sponsoring organization, and so the donor advisor doesn't have any personal responsibility for those sorts of administrative activities, and therefore the associated costs are significantly lower. Another consideration that was already touched on is the distribution requirements, and this is an area of particular attention for donor advised funds in particular, but private foundations are generally required to distribute at least 5% of their investment assets on an annual basis. And currently, donor advised funds are not subject to any annual minimum payout requirement. And so this is an advantage to the donor advised fund form. It's worth noting, though, that sponsoring organizations often have minimum requirements for activities related to the donor advised funds. Next slide, please. The other consideration, which we won't get into a great deal of detail on, is excise taxes. Private foundations are subject to an extensive excise tax regime, and after the Pension Protection Act, many of these excise taxes, as well as some unique excise taxes, have been applied to donor advised funds. But nonetheless, the excise taxes applicable to private foundations are still much more extensive, and this is another area where the ease of administration of a donor advised fund is quite clear. So, as I mentioned originally, the 4 choices may have a role in any particular donor's giving planning at any different time, and there are various considerations in addition to those that we've discussed that will indicate whether one form is preferable over another. As Janice mentioned originally, the IRA rollover is not an available option for a donor advised fund. It's also not an available option for a private foundation. So in that case, that's an area where a direct gift to a charitable organization is going to be the most appropriate structure. As I mentioned earlier, if a donor has a gift of appreciated art, it may be that making a gift directly to a museum is the structure that makes most sense there. Ellen mentioned briefly donors wishing to remain anonymous. In that case, the donor advised fund has a clear advantage, and assuming your donor advised fund doesn't have your name attached to it, it's actually quite easy to make an anonymous gift, and that's not the case through private foundations. And for a direct gift, the gift itself needs to be below a particular threshold in order to not be subject to reporting on the charity's Form 990. One other area of note, and this applies to both private foundations and donor advised funds, but where a donor has entered into a legally binding pledge to support a charitable organization, that contribution can't be made through either a private foundation or a donor advised fund. The donor needs to discharge that legally binding pledge directly through a gift to the charitable organization. So I think with that, unless you have anything else, Ellen or Janice, we can open it up to questions.
Sure.
I think questions would be great.
Yeah, hi, it's Pam Averick again. And I just want to add as well that with all the uncertainty moving forward in the tax benefits of, setting up whichever entity, there are reasons maybe now to look at a donor advised fund where you're not required to make distributions. So the funds in essence can sit if you set up such a fund, until somebody, desires to make that distribution. I just thought I'd add that. So anyway, okay, so thank you all. That was a great overview of what's going on now, in the moment and at this point in time of this year. Okay, so questions. Is this the question?
I did the other question.
It looks like Jeannie Loving asked, where was that PIF fall in this structure? What's PIF? Private something foundation? Private income?
I'm not sure.
A pooled income fund.
Oh, pooled income. Thank you. Where would that fall in?
I unmuted her line if you want to speak up and explain the question more.
I'm just reading basically the way it's, composed here on our site. It's just saying.
Right. If Deanne, if she's still on the line, she can now talk.
Yeah, Maura, can you give us a little insight or maybe a better kind of understanding or overview of pooled income funds presently or in the future?
Okay. If she's not on, this is Janice. I imagine a lot of the same uncertainty would apply to pooled income funds as well, given that the interest rates tend to be uncertain at the time. I know they just came out with the rates for the coming year, and they're going to be consistent. But if you have longer-term concerns about your return, certainly doing it now when you have an idea of what's going on, at least having the conversations. And there are many, many planned giving specialists within the charities of your choice that can speak more closely to pooled income funds as well.
Okay. And let's see. I'm not sure if we have any other questions at the moment. Anything else anybody wants to add of the Janice or Ellen who's on the call?
No, I would just say that if you wanted any additional information from any of us, we're going to be sending a link to the webinar slides, and all of our contact information is there. So if JCF or Wells Fargo or Simpson Thacher can be at all helpful to you, if you need more information about the tools, you'll be able to have the slides. So if those questions are useful,
right.
Please go ahead. And we're just happy to answer any questions. I would also strongly recommend that any advisors who are on the call who are not already members of AiP, this is a great time to go to the website, join. The New York chapter is relaunching, so we are going to be having in-person seminars. Some of them are really just informational. Some of them are practice management where you'll be able to get credit. It's a great resource. There's a lot of webinars. There's a lot of information on the AiP website. So I would just strongly recommend that you take a look at Advisors in Philanthropy, AiP, check it out, and you can certainly contact Pam or Janice or Ellen if you want more information about that.
Yeah, and I just want to add that this webinar will be on the website available to members. And also here in New York, we have a planning meeting next week where we'll discuss events for the coming year. So for members on our committee, I hope they'll be on the call. And so stay tuned for the people who are not in New York or not on the committee. We'll be sending out alerts in the coming year as far as ongoing. So anyway, I think that wraps up our call today. Thank you all for being on the call. Thank you all, Ellen, Janice, and Tamara. I don't know if she's still on the call. But anyway, thank you. Have a happy holiday, and we'll be in touch, and hope to see you at the beginning of the next year. Take care. Which is